Okay, you guys, we're now going to look at exercise 8-3. We're going to determine cost of goods sold under a periodic inventory system, and then we're going to make the end of the year adjusting entry to get cost of goods sold on the books. Okay, now you may remember this formula. We're going to start with beginning inventory. Now given here, it looks like beginning inventory. Well, let's read through it. They say SQ Company uses a periodic inventory system. The June 30th, 2016 year-end trial balance for the company contained the following information. Okay. June 30th, 2016. That's what most of these balances are. So our beginning inventory would have been at 7/1/15. So that's 32,000. Okay. Then we're going to add net purchases. Okay, now net purchases has several components. We'll start with purchases, and those are given as $240,000. Okay, we're going to deduct purchase discounts and purchase returns. Okay, purchase discounts, $6,000. We're going to deduct it though, so let's put it in as a negative $6,000. Alright, we're also going to deduct purchase returns. So we're in negative $10,000. Then we're going to add freight in. Which was $17,000. That's just transportation charges paid on our purchases. Now we'll total these numbers. I'm just going to use the sum function. So we get 241,000. Alright, then we're going to add that to beginning inventory. Gives us 273,000. We're going to call that cost of goods available for sale, not slay. Okay. That still doesn't get us the cost of goods sold though. To get there, we want to deduct ending inventory. So we're going to say less ending inventory. Which was June 30th, 2016. Inventory balance is 40,000. And then we're going to subtract that from the 273. Guess I could have put that in as a negative number. And then we'll just sum those two. And that gets us $233,000 cost of goods sold, which is what we're looking for. And I'm going to double underline that one. There we go. Now, some of you might recall that formula from back in financial accounting, but now we're going to look at the journal entry that gets us cost of goods sold on the books, which is a little bit tricky. So let's go over to our journal page. Okay, the entry is really not that bad. It's going to be made on June 30, 2016. What we want to do, you guys, with this entry, we want to put cost of goods sold on the books. We want to put ending inventory on the books. We want to take everything else, all the rest of these accounts, off the books. Okay, so let's look at it. We want to put cost of goods sold on the books. It's an expense account, increases on the debit side. So cost of goods sold. And I know you haven't seen this before, not with me anyway. So we pick up that number from over here. Cost of goods sold is $233,000. It's an expense account, goes on the books as a debit. Okay, we also want to get ending inventory on the books. Ending inventory was $40,000. Remember, the periodic inventory system doesn't have inventory on the books throughout the year. We figured that number out from our inventory count. It's given to us here. But a lot of work went into that. Alright, so now that's got those two numbers on the books. Okay, we want to take purchase discounts and purchase returns off the books. They have credit balances. Doesn't matter which one you do first. I'm going to do purchase returns. Got a credit balance for $10,000. I'm going to debit it for $10,000. And purchase discounts. Got a credit balance for $6,000. I'm going to debit it for $6,000. Now, beginning inventory was on the books from last year when we made this entry. We want to take it off. Went on as a debit. Beginning inventory $32,000. You're probably thinking we could have netted those two together. It's like keeping them separate because this is your ending amount that we put on the books. That's the beginning amount we're taking off. Alright, now what other accounts had a debit balance that need to come off the books? Well, purchases, $240,000. And then freight in had a debit balance for $17,000. And that takes care of it. That takes off the books these accounts that we're only tracking purchases and purchase information throughout the year with. Takes freight in off the books, purchases. Takes beginning inventory off the books. Those accounts are gone. Purchase discounts for the year is gone from the books. So are purchase returns. But it puts these two accounts on the books. Inventory. At the end of the year, we want that ending balance on the books. and also puts ending cost of goods sold on the books. Now, just to be sure, a lot of numbers here. Let's make sure our entry balances. You know it has to, and of course it does. Okay, I thought that'd be something a little new for you there. After working that one with me, you should have no problem with exercise 8.3 on your Connect site. If you do, please let me know. It's bothering me, so I'm going to clear it out. Just wanted to make a check there. Okay, good luck.